Hi, my name is Eric Ashburn with Argent Bridge Advisors, and I'm a partner and private wealth advisor. I thought it would be timely to discuss a topic that we often receive questions on, and that's the biggest retirement mistakes that we see from people that come to us for help and what we would advise based on our experience. Today, I'm going to name six of the major retirement mistakes. This is not all of them, but just a few very common ones, as well as quick steps to take if you are nearing retirement and you would like just to have a few pointers going in. The first mistake that we see is being overly aggressive or overly conservative. Oftentimes, clients realize that they have a 30 to 40-year potential retirement. And for that reason, they want to get really aggressive in the market. That can be a mistake based on their need, because looking at history, some of the situations that fail result from being too aggressive too early and your assets really taking a fall at the beginning of retirement. That's a risk that we always evaluate, but something to absolutely be aware of. The other side of that coin is being overly conservative. That can be a problem due to inflation, things getting more expensive like food, healthcare, things that you'll need in retirement, and running out of money or having less than we planned for as a result of being too conservative. So it's really about remembering the time frame and finding that ideal balance. That is something we absolutely help with for all of our clients. Number two is being overly optimistic with your assumptions. So thinking you'll spend significantly less in retirement than you are now, or assuming that your assets are going to grow at a rate that might not be sustainable or realistic compared to the rest of history. So if we're using numbers that aren't realistic, your plan's only as good as that data. So it can fall apart, or more importantly, you won't see reality played out the way that we planned for. So it's important to look at assumptions and make sure we're using as accurate of data as possible. The third mistake we see is putting all your eggs in one basket. That can come in the form of too much in your company and stock options, too much in Bitcoin, too much in large US companies. It can come in a variety of ways. One stat that I find interesting is from the years 1980 to 2014, 40% of companies had a loss of 70% or greater and never recovered. So I think that's very telling of it can be dangerous to put all your eggs in one basket. Diversification is key, and being aware of what risk each company or singular holding can present. The fourth mistake is using guidelines and advice blindly. So I know all of our clients have heard us say this, but not all situations are the same. You have your personal situation. So anyone that's giving you advice without knowing your situation, just know that it might not be what's best suited for you. Rules of thumb are just that, rules of thumb. They don't apply to everyone, and your situation is very specific to you. The fifth mistake is spending your inheritance or raises as they come. So having a lifestyle bloat or spending an inheritance, or really counting on an inheritance. First of all, only about 20% of people receive an inheritance. And I would say in our experience, many more people plan to receive one than actually receive one, or it ends up being less, just because end of life, healthcare, these sort of events are very expensive. So it means less for inheritance. So that's something that can be difficult to count on. And then of the inheritance, the people that receive them, about a third of people spend their inheritance within the first 2 years. And that can just really change the sustainability of a portfolio, or that's money that could have been invested and given you cash flow for the years of retirement. So just something to be mindful of. Even lottery winners have the same sort of statistics. They save on average 16 cents to the dollar. So I know it's tempting when you get a big inheritance to just go ahead and spend it, and not to say you can't spend any of it, but just something to be mindful of, that that's an asset that could really work in your favor if we planned properly. The last mistake I would say is procrastination. So many people, they wait too long to save. They just say, well, we might as well wait longer. That's a huge mistake. We should get started as soon as possible with your planning to leave you with as many options as possible. I would also say that just the economy and tax rates and rules are available now that might not be available later. So we really want to take advantage of the years that we have now for planning. So those are the 6 mistakes. A few quick steps that you can take as you near retirement is evaluate your expenses. So I like to think of the rule of 300. That means that every $1,000 a month that you can save or not spend will buy you about $300,000 worth of retirement savings. So that $1,000 a month might not feel like a ton, but if you think of it in terms of having $300,000 more to spend in retirement, that's really impactful. And so definitely worth evaluating. Second, I would say know the state that you live in and the inheritance and estate laws in that state. This is very important because states are different and have different rules. And if you're planning to spend retirement in a state, it's important to know what those rules are just to maximize the benefits for you. And then secondly, is if you are planning to go to a lower cost area, just knowing that and expressing that to us so we can start to look at what that means for the big picture, because it could mean having more money to spend in other areas of retirement, just something to weigh. And then lastly, I would say understanding what you have and what you owe. Just making a list, having a net worth statement is really valuable just to see what are your old life insurance policies, what are your old pensions or retirement accounts, what stock options do you have, health savings accounts are often forgotten, old annuities. You should be evaluating those to see if they can work better for you now, or what sort of income will they present in retirement. So understanding what you have, very important. And then lastly, what you owe. What are your debts? How long are you going to be paying on them? What are the interest rates? This is something important to evaluate as well. Often we see prospects, people come in with huge amounts of savings in the bank and then a credit card or something that they're paying 10% on. These are situations where you can save hundreds or maybe thousands of dollars just by moving money around. So definitely worth looking at what you have, what you owe, and doing that sort of analysis. That is all for today. I appreciate the time. Please feel free to reach out to us with any questions and we'd be happy to help. Talk to you soon.